Okay, so what is your view on rotating some funds, some allocation from fixed income market? I know we spoke about this before to alternatives like gold at a time like this. And of course, Bitcoin. Bitcoin has been on a tear recently. As of Thursday, it was about $112,000 per unit of Bitcoin. Currently, it's about 108. I know you're not a fan of Bitcoin. I'm also not a fan of Bitcoin per se, but the reality is that a lot of investors, especially high net worth investors, have allocation to Bitcoin. And when I say they have significant allocation to Bitcoin. Hi everyone, and welcome to a brand new episode of Market Tape on Street Exchange. We're back with the show, your best companion for staying up to date with the global capital market and making the best and most informed decision around your investment. This is the show you don't want to miss. So if you haven't subscribed to this show, make sure to subscribe. And I'm back on this episode with my guy, Okudili. Welcome on the show.
Pleasure to be here.
Yeah, quite a number of things that we're going to talk about today, from the judgment awarded against Fidelity Bank to the US credit downgrade and how it affects investors, particularly in emerging market and in Nigeria. So we have a few things to get into, but as I always do, before we get into our discussions, this show is purely for information purpose. Before you use any of the insight we share on this show to use, make sure to run it by a qualified investment advisor. So on to the US credit downgrade.
Okay.
Yeah, if you look at the last 2-3 years, most of the money that has come into the market has gone into the fixed income space, whether you're talking about money market, treasury bills, bonds, euro bonds. That is where most of the money is coming to the capital market has gone into.
Within the Nigerian market.
Within the Nigerian market especially.
Correct.
Yeah. And when you...
Foreign portfolio investors.
You said what?
Foreign portfolio investors. FPIs.
Yeah.
Not FDIs.
Yes, foreign portfolio investors. Yeah, that is true. And then when you speak to especially retail clients, you got to talk about the risk of investing in these fixed income securities. And one thing we always tell them is that relatively the risk associated with investing in the fixed income space, especially when it comes to sovereign securities, is low relative to other asset classes.
Very correct.
But that does not mean that there is no risk investing in those securities.
Correct.
There are some risks that comes with investing in fixed income securities. And Moody came out. Moody is one of the top 3 rating agencies in the world. They came out to downgrade the US credit rating. US is about the only country that has a AAA rating. AAA is the highest rating you get as a borrower. And they got downgraded from AAA to AA1 by Moody. Actually, Moody is the third credit rating agency to downgrade the US credit quality. And what these rating agencies do is basically tell the market, tell investors, lenders, your ability to repay. So US is still at that high quality credit rating, investment grade rating.
Investment grade.
Yes. But to me, this is something to pay attention to if you are a fixed income investor. So even though we say these securities are risk-free, but you don't act as if countries would never default, and this information should start to reflect on investors' portfolio. So let's even talk about the US getting downgraded.
Okay, Moody cited worsening physical deficit positions as one of the reasons for the downgrade.
Yeah.
And that they are not very certain about what the future will pan out like. you see a Trump administration that is pushing ahead with tax cuts and increasing the budget deficit. So the budget deficit means that the US government will borrow more. But the revenue profile too, to service these debts and all that, they also have a huge debt burden in the US economy. It's giving enough concerns to rating agencies to now evaluate the credit quality, the ability to meet obligations by the US government. So they've gone from the highest level to what it is now, AA1, which is and that's downgrade, no matter how little it is triggering reactions in the financial markets. We've seen a week in the US that have led to share stock prices going down, declining. I've also seen, not recently seen, spikes in fixed income yields. What that means is that the prices of existing fixed income securities are falling, so their yields are
going up. Yeah.
So that has a grave implication for every other person who is invested in the fixed income space, especially those who are long, pension fund administrators and the pension fund managers who have long positions in long dated maturities. So what is the implications for the frontier market like ours is quite very significant, and we should as a country begin to look at them.
Okay, if you look at the US debt to revenue ratio, it's actually very high, about 123%, meaning that they are borrowing far more than the size of their GDP. Their total debt is about $36 trillion, whereas their GDP is around $29 trillion. You know, for Nigeria, it's not that bad yet.
We're at about 50%.
Yeah, we're at about 50% our debt to GDP ratio. So you even wonder whether this sort of investment grade credit rating for the US is even appropriate in the first place, given the extent of their debt to GDP coverage.
Well, US have a special reserve status, especially their currency, so they can subsidize the world. The world can subsidize them. Everybody, because they have the reserve currency status, and then it's the petrodollar. All transactions on crude oil source and all that happens in the US.
USD, yeah.
So they have been printing, and the world have been subsidizing them. So they've been getting away with it. So that's why they could have that high level of debt to GDP ratio, and nobody worried, because everybody had faith in the US economy and their strength to surmount whatever challenges, monetary policy challenges that might come up. But now we have a change of government, a new orientation, a paradigm shift from the Trump administration that is causing everybody to worry. So that's a significant change that has happened, that is now bringing everybody to look at, is this economy, will they continue to maintain this reserve status? Please recall that a lot of people have lost faith in the US securities, and they are moving away from US securities, dollar-dominated securities, to other clients like the German bonds, like the European bonds, and Japanese securities. So that drift away from the US dominated securities is contributory factor to why these rating agencies are now taking a second look at the US economy and their capacity to meet obligations.
Okay, interesting. Back to Nigeria, you've mentioned that briefly. We are not at that level where our debt to GDP has gone out of hand, but at 52% or thereabout, at what point should we start to worry for Nigeria?
No. What Nigeria should be worried about is not debt to GDP ratio, rather it is debt servicing to revenue,
which is about 144%.
Is that what it is now?
Currently.
Okay, so last time I paid attention to the news, it was about 90-something%, which was actually very worrisome. So if
I think it's as of Q1 should be around 144%.
What that means is that our total revenue is not enough to service our debts.
So we need to create more debt.
Why? To service debts or increase revenue?
I mean, revenues, we can't increase revenue overnight. That's the point.
So it's a source of worry that your revenue capability is from the revenue you service the debts. So if your revenue keep worsening, then you are likely going to default. So it's not a matter of whether your debt to GDP is this or that. It's what is your revenue profile and how much of that revenue can be used to service debts. And are you able to service your debt and still have a leg room to do other things?
So with the reforms of this administration, we have some expectations that the revenue profile of the country would improve. We've seen improvement in tax revenue. Sadly, oil price is down below $65 per barrel. But we've seen progress in other sectors, the non-oil sectors.
By current revenue profiles, oil is no longer the major revenue earner for the country.
Mm-hmm.
So, and it's interesting and good enough that we are beginning to move away from non-oil revenue. So, this administration is pushing for a more simplified, transparent, and uniform tax administration system. So I just hope that bill is passed. One thing that will come out of that is that it will simplify the tax process, possibly automate it, so ensure that all tax revenues and levies actually goes to the coffers of the federal government. And with that, the revenue profit, and then bring a lot of more people into the tax brackets. You will notice that even for operators in the informal sector that operates one POS or the other, they've been captured into paying stamp duties and electronic tax on deposits. So as we have more financial inclusions and bringing more of the informal markets, informal sector into the formal markets and formal markets and all that, there will be an increased revenue profile that will help the states to have a better capability to service the obligations, one of which is the debt servicing.
All right, so one thing that worries me about the Nigerian debt profile is the fact that a preponderance of our debt is issued by government. And when we look at debt, we always look at it from the perspective of what is it used for. Having too much debt is not bad in itself. Is it creating productivity? And if the private sector, most of these lenders are not lending to the private sector, instead lending to the government. If that is not happening, then it's going to stifle productivity. And to me, I feel like we need to at some point move from the focus on using tax to generate revenue to also generating revenue from the private sector significantly, because if the productivity is not improving and tax collection is improving, it means in reality that businesses are dying. That's what it means to me. So I think we need to transition to the point where, as this debt is growing, we're seeing some of it go to the private sector.
Yeah, I concur with you that the private sector is being crowded out by the government borrowing. No doubt about that. And the government is borrowing at 20% levels. Now, if government is borrowing at 20% levels, every other lender will demand a significant premium from the private sector.
Mm-hmm.
So we need to encourage more private sector credits. That I concur with. But here is the challenge. The challenge is, how do you deal with a government that feels that the provision of infrastructure is the sole responsibility of government? That is where we might have a problem. Now, if government can realize that the private sector is a partner that they can collaborate with to provide the much needed infrastructure in the polity, then we can go a long way. Then if you have private sector led public sector financing, it will free the government from the burden of borrowing. largely, most of the borrowing, a large chunk of it might be geared towards consumption. Because if you analyze the expenditure profile, how much of that is recurrent and overheads? This recurrent and overheads caters for who? And this is always expended 100%. How many people do we have in the public service? Why should we be borrowing to service maybe less than 3 million people in the public service, as overheads and recurrent expenditures on them? Now, is the public sector very efficient, even with the overlapping MDAs and parastatals that we have? So the private sector have a lot of opportunity, a lot of role to play in funding the infrastructure. One benefit you get in involving the private sector in financing the public infrastructure that we do need in the country is that we get management expertise, and then we get financial expertise in the rollouts and in the management of such projects. And when we do this, we save a lot of costs. We save the burden of the capex of the project. And then doing that will also mean that unneeded projects, unbankable projects may not
attract funds.
Attract funding. So budgeting will now be based on the merits, not because I want to cite this here and there for political reasons. Then, secondly, is that this is a large chunk of the budget is recurrent and overheads, which services the human resources in the public service, which a lot of people have seen is overbloated. And they were even seeing an Eurosonye report that have suggested that will streamline the public service. But year in, year out, since the Jonathan era, when that report was produced, we've seen every administration play politics with it. They just come out, we're going to implement it, and that's the end. So once we have the willpower to deal with the issues, then we can begin to address the debt burden and the idea of borrowing to service consumption. And we should not lead us anywhere. We should just need to reduce because at some point there will be a physical cliff and we might just not survive it. So it's very important that we look at our debt sustainability and see how we can revamp it. Are we borrowing for the right reasons? Are we borrowing to fund production? Or are we borrowing to fund consumption?
So listening to you, I'm just thinking of how we're going to get to this point where there's a balance between funding infrastructure between the private sector and the government. So what is going to trigger it? Is it the government getting to the point where they say, hey, private sector, come in and help us with this? Or are we in this situation because we just don't have the size of the market to handle such projects? Because you also have to consider that our debt market is small relative to the potential size of the economy, to me.
Well, I don't think
because if you look at the entire debt market, what percentage of that debt market is from the private sector? Very insignificant. So relative to the size of the global Nigerian economy, I feel like a lot of businesses happen informally. So
going by the testimonials of some infrastructure funds and some infrastructure funds that we've seen, like the Nigerian Infrastructure Debt Fund, their performance has been very steady. There are specific areas of specific infrastructure gaps that needs to be filled urgently. Things like midway, things like power and all that. Now, things like housing, and road infrastructure. So we've seen that fund financing very profitable, very much needed infrastructure project, and they've been doing well. It's a listed fund in the market.
So it means the private sector can drive itself.
So I'm going by the fact that most of, just like the recently, what we hear from the recently ended Sukuk public offer that was trouble, that had a lot of retail participants or participation. If the figures we are hearing is true, then it means that we really do have that market size to fund infrastructure. Now, what you will realize is that when you invite the private sector to fund infrastructure, the funding may not just be local, the funding can also be foreign. And in this case, it no longer be a foreign portfolio investor that is hot money. This will now become a foreign direct investment that is funding a project that has a long-term gestation period, maybe 20 years. So you attract foreign direct investment, you attract local participation. So from the success of the capital raise that the banks have had in 2024, the level of subscription of almost all debt issuances we have seen in 2025, which are largely oversubscribed, is an indication that we'll have enough funding capacity to fund this. What is lacking is that bankable project that needs to be funded. So the assurance that this is bankable, this is comforting, is what is lacking. And what will provide those comfort is the sincerity of government and fidelity.
Is it the sincerity of government? Because
sincerity and willingness of government.
From my interaction with investors in this space, with this infrastructure project, one thing most of them consider is the risk, because it's long-term in nature. Mm-hmm. So I feel like the risk is beyond government. It's a sovereign thing.
So now let's
the macroeconomic environment.
Let's look at how you can de-risk those factors. Let's look at how you can de-risk them, and make it viable. Number one, if a government says we are going to do this road, and this road is going to last 20 years, can we put a legislation in place that prevents subsequent administration from revoking that contract and keeping to the terms of that contract?
Mm-hmm.
So that's what will bring the risking. Government is a continuum. So what we have is civil administration, even at the national and the sub level, where everybody wants to identify with their own unique projects. Nobody wants to continue the projects of the past administration. So if you have a situation where people knows that, irrespective of the government in power, that the terms of the contract will be respected, then people will have faith. Now, if people have faith that your legal system works, much like the case where a matter that should be adjudicated in 30 days takes 24 years to be decided upon, everybody will have faith. So your ease of doing business, your legal access mechanisms, faith in the legal system, that contracts can be, the sanctity of contracts can be enforced by the courts, and that the government can keep to the terms of the agreement. That will give a lot of confidence in the system. But I also think that the government is desirous of attracting the private sector, because that they have the infrastructure called COP that was set up with the 1 trillion naira capital base. So that's because they are desirous of attracting private sector to fund the infrastructure. Also know that we now have infra credits, which is a guarantee scheme to guarantee investments in infrastructure projects. So that infra credit, which is co-promoted by NSIA and some foreign credit organizations, is giving comfort to a lot of infrastructure projects, so that people can get funding. People can fund it because there's a guarantee from the infra credit that says that if you fund this project and it fails, we can guarantee you your amount to a certain amount of money and all that. Mm-hmm. So those are developments that gives confidence that yes, funds can be attracted to fund infrastructure projects in Nigeria.
So we just need to sweat this infrastructure in place to drive investment.
A lot of jobs needs to be done. Both the private sector and the government needs to collaborate more. The private investment bankers and corporate finance specialists needs to do more to identify the bankable project, create a product around it, create the necessary SPVs, get the necessary credit guarantees, test the laws, and then come out with a project that people can fund.
And funding will come.
And funding will come, sure.
All right, let me shift a bit. You mentioned interest rate at 20%. The recent Sukuk offer was done at 19.75%. And one problem I see with high level of interest rate is that, and this is something that we don't talk about enough, it creates inequality more. Because who benefits from this high interest rate? Those with more money will benefit. And someone ultimately has to pay. Because you are lending to government, the bill will fall due at some point and the government needs to pay back. So high interest rate in itself creates inequality. It increases inequality in the system. And in Nigeria today, we have a situation where you just have about 5% of the population controlling the...
Our Gini coefficient is very high, so it shows a high level of inequality in Nigeria, no doubt about it.
Yeah. So in a way, sustaining this level of cost of debt is injurious to the country, not just from a repayment point of view, but also from inequality point of view. So, and we've seen with the Sukuk offer that the appetite is not just about the rate, it's about the ethical considerations, the ethical appeal for the Sukuk issuance. Is this not an opportunity for the government to mine that avenue? Like, I mean, if this offer was at 15%, you will still get substantial subscription.
Geneta, let me ask. Let's dwell on the issue of interest rate and inequality. You are complaining that...
I'm not complaining. I'm just stating it.
You are complaining that the high interest rates is worsening the inequality situation in the polity.
Yeah.
Which to some extent I will agree with you. Yeah, but let me ask you, what other options are available to the monetary policy other than what we have now? So do you force the premise of their MPC decisions?
No, not at all.
So
not
what
at all.
could they have done better other than letting rates remain as this high?
I mean, so the whole interest rate thing is a circle. You get to a circle where rates, where at a point where interest rate was...
High interest rates helped in achieving price stability.
Yes, it has. It has.
So as painful as that prescription might be, it's solving a problem.
A
big problem. That big problem is that we no longer want to experience the peculiarities of 2024, where we had high volatility in prices. So it's a lot better for planning, for investment decisions, that will have a stable pricing system in the polity. So the high interest rate is help fight and maintain the naira.
But there are consequences.
Yes,
that is what I'm saying.
So yes, Nigeria has,
Nigeria
does not have an inclusive growth. That I agree. So what do we need to ensure that we have inclusive growth within the polity? And that is where the quality of the human resource comes in. That is where the quality of your infrastructure systems, the healthcare, the road system, the educational system comes in. Because in my opinion, the best liberator from poverty is knowledge, education. And then if you want to liberate the farmer from the poverty line, address his challenges, core of which is access to market and energy. So it's not interested that we address those issues. So the fundamental issues is deal with the issues of education, insecurity, access, energy. and then you can be solving the problem of poverty.
Okay, great point. But let's shift a bit to what investors need to do. We've spoken at length about the issues, the risk that we currently carry globally. And if we're not careful, this, just from the body language of the US president, this level of interest rate is likely going to persist. And if it persists, the situation will worsen for a lot of countries, including Nigeria. Because if the government continues to borrow at 20% for the next couple of years, it's going to even worsen our debt service to revenue beyond what it is today. So as an investor, looking ahead, what would you be doing in terms of allocation to the fixed income market?
Well, yeah, the one thing that the downgrading of the US economy would trigger is flight to safety. Now, if the use of US treasuries or US bonds continue to rise, to make the Nigerian issued debt instruments to also have yields rising, and people would want to move away from frontier riskier markets, the frontier market that are much more riskier, to a safer market. So we might see people fleeing from Nigerian securities, and that will worsen yields. And that would compel CBN or increase our cost of borrowing. Because as our yield grows higher, our new issues will be done at those yields.
Yes.
So cost of borrowing will be much higher for the Nigerian and other frontier economies. So for an investor who is, if you have the cash, is to first determine what the likelihood levels would be. And if you are playing Naira, I would still encourage and target and take advantage of the rising yields.
Okay.
Yes, because yield is about returns.
Mm-hmm.
And investors are looking forward to expected returns. So if the expected returns are likely going to go higher, so I would like to have a keen interest of seeing if I can get higher returns on my cash positions. So you can even use the concept of laddering to also average your portfolio and enhance your bond positions.
Okay, so do you think, like, if you're looking at the space in its entirety, in terms of duration management, it should play some role at a time like this? Instead of going longer, for instance, investors may need to keep their investment within the short to medium term duration, just to manage the sensitivity to interest rate. And then you look at things like investing in foreign currency bonds. So if you're investing in Angola, for instance, would you rather invest in the domestic currency in Angola or the euro bond in Angola at a time like this? Considering that investing in these two different asset classes carry different
if you are investing in
percentage
the
of
sovereign
risk.
of any nation, if you are investing in the sovereign of any nation, you need to take their physical position into consideration. What's their debt profile? What's their revenue profile? And what's their capability to keep maintaining? Do they have sustainability in maintaining their debt levels? Recall that a few years ago, Ghana defaulted in meeting their obligations, and they had to restructure their debt obligation on foreign dated securities. So, and when you now play in the local currency of that company, of that sovereign nation, so you need to now gamble with issues of exchange rates. And
when you're converting back to your home currency.
And not just exchange rates, but also the FX liquidity in that country. Because you might be trapped. A lot of people were trapped in Nigeria for years until the coming of Caruso. So those are constitutional issues. what's the ease of me going out if I want to go out? And then if I'm carrying the foreign debted instruments, what's the capacity? What's their revenue profile? What's their foreign earnings capability to be able to meet those obligations? So it's really very important. And more, you also need to pay attention to their credit ratings, sovereign credit ratings. As US is being downgraded, all other sovereign nations are also being reviewed and either upgraded or downgraded.
Nigeria was recently upgraded by Fitch from B- to B with stable outlook.
Citing the reform outcomes, which is not that. But that did not anticipate the worsening US economy in that report.
So and the trade wars.
Maybe as the effects of this downgrade and the likely impact it has on frontier markets beginning to, maybe another cause for review might happen within the rating agencies.
So we need to pay attention to that.
Things are full, you need to follow the trend.
Okay, so what is your view on rotating some funds, some allocation from fixed income market? I know we spoke about this before to alternatives like gold at a time like this. And of course, Bitcoin. Bitcoin has been on a tear recently. As of Thursday, it was about $112,000 per unit of Bitcoin. Currently, it's about 108. I know you're not a fan of Bitcoin. I'm also not a fan of Bitcoin per se, but the reality is that a lot of investors, especially high net worth investors, have allocation to Bitcoin. And when I say they have significant allocation to Bitcoin. And as an advisor, you need to also pay attention to what is going on in that space. Because when you have meetings with them, these issues get discussed, it comes up. And if you look at Bitcoin as an asset class, in the last 10 years...
So you are now looking at this asset class, no longer as a currency.
Well, okay, let me rephrase that. If you look at that in Bitcoin in the context of, in a portfolio context, it's about the best performing.
You are right to say asset class, I concur with that. But I mean, there's a switch, there's beginning to be a switch from Bitcoin as a currency to Bitcoin
as an asset class. Yeah, agreed. So, in the last 10 years, it's about the best performing asset class with the return is over 45,000%. So, you can't help but pay attention to it. You may not have it in your portfolio, but you're going to work with clients, families that have it as part of their portfolio. So how would you treat that at a time like this where we're seeing some increasing risk profile with these asset classes that we've considered near risk-free? How do you...
Bitcoin is near risk-free?
No, I'm speaking of fixed income bonds, sovereign bonds particularly. We look at them as almost risk-free. So at a time like this where you are starting to see increased riskiness and possibility of a default, because if you are looking at Nigeria, for instance, and our debt service to revenue is over 100%, there's hope that could improve this year with all the reforms going on. But if that does not happen and things get worse, it may not be justified to leave all, say if you have a 60-40 portfolio, to leave 40% in fixed income alone, that may not be justified. So you need to move out some allocations to some of these assets.
Okay, so upfront, probably my disclosure is that I have no keen interest in cryptos. Because one, I'm wired to view investment from a fundamental approach. So I look at it from the productive base that backs up that asset class. So there has to be an underlying value. So I don't have the use case for most of the cryptos. I don't see the underlying asset that backs the valuation. So it's difficult for me to do the valuation.
I carefully did not talk about crypto. I kept mentioning Bitcoin because again, I think we're on the same wavelength as in terms of our attitude to investing in crypto.
When I encounter clients that are interested in Bitcoin or cryptos, I will probably declare that I don't have the expertise to discuss this or to offer any form of advice on this.
Oh, so you give up.
I give up.
Okay, interesting. How about, I mentioned gold. Does it make sense to hold some allocation in gold at this point?
Yes. Gold have use cases. Aside from being a source of value, a store of value.
Have you bought some? I know the last time you said.
No, I said I could buy gold ETFs.
Yeah.
You understand? But I have not had maybe the wherewithal to invest in the gold VTI. So my investable funds are pretty busy or occupied, more or less. But for people who have investable funds, I encourage that if you are worried about the unfolding scenario, economic scenario that we face, then you can take positions in gold. Yes, and you can invest in gold, either physically investing in the gold or using gold ETFs. Gold has very significant use cases. Are you aware that gold is the best conductor? The best material conductor. So copper is just a substitute for gold. So where people are not using gold because it's extremely quite expensive. But if gold prices fall, their demand as a conductor will rise. So you have other uses that you can apply gold to. You can also apply it as jewelry or ornaments and all that. But so there's a fundamental use case for gold, and aside from being a store of value. So I can always encourage people to, as a flight to safety, to consider gold. And historically and traditionally, a lot of Nigerians, a lot of people in the informal sector have always seen gold as
store of value.
But the problem I have with them is the ease and the disparity, the transaction cost disparity in converting it to cash when the need arises.
Because they're not doing it through a formal.
There's no formal market.
Yeah. Okay, so let's shift gears a bit and talk about Fidelity Bank. This week, the news came out that a judgment was awarded against Fidelity Bank. Now, we're not sure of the figures. From what I've read, the dollar value of that judgment is about $139 million. And we've read different versions from 14 billion naira to 255 billion awarded against GTB in favor of Sagecom Concepts, arising from a legacy obligation that has subsisted since 2002 or thereabout, 2002 or so. Now, we've read so much about this issue. What is this doing to, I know you have position in Fidelity Bank, in your personal portfolio. So, listeners need to be aware because you may have some bias, when you render opinion relating to Fidelity Bank. I don't hold position in Fidelity Bank. So from an investor's perspective, what is this doing to your view and your holdings in Fidelity Bank?
Yeah, before the investor's perspective, I think we need to analyze the issues at stake.
Okay.
The development around the Supreme Court judgment and Fidelity Bank and Sagecom Concept, it reinforces my belief that if I was a lender, I would not lend against real estate backed credits. So it still goes back to the caution, the challenges that banks or lending institutions have in lending to the public. Here was a legitimate credit transaction done in 2002 by FSB against lent to GCAPA, secured with a real estate asset. You did not pay those assets. You foreclose. The bank took initiative to foreclose on the asset, and you got a court injunction that they shouldn't foreclose on the asset. And the technical issue here that Fidelity Bank is paying cost for is that they sued against cost reduction. So, with the experiences that Fidelity Bank will get, let's not speculate over what the judgment sum is, because it's not yet clear. Fidelity, as we gather, has sought judicial clarification. and have even have an injunction against further publication or banding of figures around that judgment until there's a judicial clarification. No matter what the outcome is, would it reinforce the zeal by any lender to lend to the real sector or to the private sector when the attitude of the borrower is not to repay back? So that's the major issue we need to address, and that pervades the entire system. Most of the macro lenders, microfinance banks that have retail loans, consumer loans, all form of credits are facing a huge challenge in recovering those loans, because we have a culture of people just wanting to take loans and never pay back.
So it's not even necessarily about lending against mortgage-backed security, just our attitude as a nation to borrowing.
You are asking for that the banks are demanding for collateral, but here is the case where the collateral was perfectly provided,
and yet
there were still issues.
You couldn't enforce the sale of.
There were still issues that has been lingering since 2002 to date. That also shows the fidelity issue, the fidelity question I have around our judicial system and our legal system. Why would a matter of this nature be in courts for about 15 years? This is a commercial transaction that have grave implications. The outcome have grave implications on every parties involved. Why can't this have been decided upon within a year? Can't we have accelerated hearing on contract issues?
Or even have timelines. Like if this happens within 3 months, it should be concluded.
So this is one issue that highlights the difficulty in assessing credit in the Nigerian banking system. And it has to be addressed. In fact, what most lenders prefer to do is to accept only financial assets as collateral, because that one is it's very easy to foreclose. Number one, you don't need the legal loan mortgage, you don't need the governor's consent, you don't need the minister's consent on the pledged financial assets. There's a dated authority to sell, clearly stated. So and there are triggers, just like we do margin calls. So once that trigger is set, you don't default. The guys that asset is sold and settled, and there's not much you can do. So most financial institutions now prefer to accept your financial asset rather than real estate assets. And then if you hope that your inventory, your personal guarantee can work, is enough for you to access bank credit, sorry, I don't think the banks will listen to you any longer.
Yeah. I mean, these are real issues that we're facing. And similar to that, this came from a legacy transaction. The initial loan was not even given by Fidelity Bank.
It was granted by FSB.
FSB.
Which is one of the banks that merged with Fidelity Bank.
FSB.
FSB.
Yeah.
FSB.
Yeah.
Federal Savings Bank.
Mm-hmm.
Which is an offshoot of the post office.
Okay.
Yeah, it was a subsidiary of the Nigerian postal system. So FSB merged with Fidelity Bank. So of course, with the merger, you assume asset and liability. So this was one of the legacy assets that the bank assumed. And if the bank felt that this was a bad debt, as the case may be, they would have sold it to AMCOM when AMCOM was set up. But they felt that this was a well secured. Recall that AMCOM was set up around 2010. This property was sold in 2011. So as at 2010, Fidelity, in their wisdom, would have said, I think we'll have a perfect collateral. And since this has done, it was in our right to have foreclosed on these assets. So when there is a legacy issue, it's neither here or there. Access Bank took over Diamond Bank and went after debtors of Diamond Bank, and they recovered it.
So the point I was going to make is that some institutions are better wired to manage mergers and acquisition than others. So if you look at banks like Zenith, GTB, they're less active in that space of mergers and acquisition. But you look at, and you just mentioned Access Bank, it's like it's their thing. The whole organization is better wired to deal with mergers and acquisition, because when you're acquiring, it requires extensive due diligence.
Well, Nathan, I think you also need to put things in context.
Mm-hmm.
There was a compelled merger, so to say, in 2005. The Soludo era of being a CBN governor imposed a recapitalization deadline on all banks. We had 84 banks.
The 25 billion recapitalization.
5 billion recapitalization. So the banks were doing all that they can to ensure that they beat that deadline. So if you did not have the muscle the likes of GT and Zenith had in going, maybe they got a whiff of what was going to happen. They went to the market early. And because they also were also relatively big at that point, and they all had brand equity and were able to go to the market and raise and acquire funds to meet the capitalization on their own without merging within the other person. That was not the case with a lot of other banks. Even one of the best brands in banking then, Stanbic IBC, did not do it alone. It merged with Standard Chartered. I get my point.
Yeah.
Even Access Bank as at then did not. So Fidelity Bank, was was the order of the day then.
No, you get my point. I'm not faulting them for merging.
No,
I'm not faulting them for
what I'm
merging.
saying is that at that point they had no choice.
Yeah.
But after the consolidation, then you begin to see who is keen, who has a strategy of organic growth, and who have a strategy of inorganic growth. But you can't use the era of that 2005 to say this person adopts organic or this person doesn't adopt organic.
I mean, after the merger,
after 2005, Fidelity has adopted organic growth.
Agreed.
And they've been very successful at it, to a point that they have been evaluated whether at this year's second tier or first year, given their growth rate and increasing balance sheet size and profitability. So it's an organic focused firm. So you can't say they have been involved with mergers and acquisition. So yes, there's a strategy direction between GT, Zenith, and Access Bank. Access Bank believes in achieving growth via inorganic growth, and they have achieved that. But is there a synergy yet? Are people seeing the synergy? Is it translating to better shareholders' value? That's the question we also need to ask.
And that was my point, actually. This is where I was going to that.
What happened in 2005?
I mean, people had the option to raise capital on their own or merge.
Within the time frame.
So if you're going in,
you don't have an option.
What you're saying is like, I'm 30 years old. My parents say I must marry before the end of this year. So I go out and marry somebody and then blame it on my parents for asking me to marry before the end of this year. It's something like that. So I'm just pointing out the fact that if you choose to go the route of mergers and acquisition, it comes with its own perils. And this is one of it, that you're going to acquire the assets and the liabilities. You're acquiring the good and the bad and live with the outcome. And when you're going into that mergers and acquisition process, you also have to have the ability to manage the process entirely to achieve the desired synergy.
Correct.
And I'm saying that some firms are better at it than the others.
Within the Nigerian context, which banks would you say are better at mergers and acquisition than the others?
In a sense, Access Bank, because they have repeatedly right from the 2004 2005 era, they acquired Intercontinental Bank, I think Oceanic Bank. Is it first? No, I think it says FCMB.
They didn't acquire Oceanic Bank.
They
They
did.
acquired Intercontinental.
Okay, Intercontinental acquired Oceanic.
Intercontinental did not acquire Oceanic. Eco Bank Nigeria acquired Oceanic.
Yeah. Sorry about that. So they acquired Intercontinental, Diamond Bank, and who again?
They acquired Marina International, so some other banks. Within that 2025 era, there also was a merger of about 3 banks
Into Access Bank.
into Access Bank, yes.
So in a way, we can argue about the synergy.
No, post that 2005 consolidation, I would like you to point out which other banks have gone into acquisitions and got caught or got bought. The era of you have to put this in context. Putting this in context is that within that 2004 and 2005, the banks were left with not plenty options. And that era also saw a lot of very promising banks go under, because one, they were new banks, they have just operated for a few years, and then you were compelling them to where would they get capital from? So and some of them went to mergers with strange bedfellows and never recovered from it, and that was the end of it. So that era was a special era, so let's not dwell on it.
Okay, so let's move to this era now. So from an investor's perspective, is this an opportunity to buy Fidelity Bank? I mean, we saw the share price go down by about 16%, and then the news came out that the CEO acquired 18 million shares of the bank, and somehow the market price recovered a bit yesterday by 7 point something percent. So how do you look at the current price at 18 naira? Is there an opportunity to buy? Because we know that when there's a negative news like this, the market would overreact. Is the price level today, is there an overreaction? Is there an entry point for you?
Before you begin to ask whether the price level today is an entry level, what I would possibly look at is, at the 20 naira price, was that a fair value? I don't think it was, compared to other banks. I'm using other metrics like P ratio, price to book ratio, and other metrics. Was it a fairly priced at 20? I think it was relatively overpriced.
Overpriced at 20?
At 20 levels, compared to their fundamentals. That's my personal opinion. So, but I'm not one that is focused on prices, because for me, price is a noise. So I look at the long-term fundamentals. Long-term fundamentals of Fidelity Bank, for me, until we assess the impact of the judgment debt on their balance sheet, remained a very good bank, because their growth rate levels were quite impressive. They are growing across metrics at about 30%, quarter on quarter. That was very impressive. So when you are investing, you're looking at the growth rates. Some in their peers in the industry are already stagnating, but they were growing at a faster rate. So that could be a consideration that people look at and say, I'm going to buy this. Then the quality of their board can non-public focused, quietly doing their things and achieving results. So those are things you will look and say, this is a strong solid that has a very good future. But you have to do your valuation and determine what your entry level is based on fundamentals, and compare the P ratios, and wait for the prices to come down to that level, and then you can enter. So I might not say it is good price to enter, but I just know that at 20 levels I will have bought.
if you're not focused on price, why won't you buy at 20? If your view is long term, so why won't you buy at 20? Because markets can be irrational and they can remain irrational for long.
When we analyzed Fidelity a few years ago, it was at 2 naira.
Mm-hmm.
So for those who have entered at 2 naira and all that, so
some could have argued at that time that it was overpriced at 2 naira.
Yeah, but
I mean, I never owned Fidelity even as at then.
Okay, so when those people thought, even if the price comes to 10, they don't move it. So they just looked at where their considerations could be: my dividend payout is this, I'm getting this, the value is basically created. So I put a hold on it. I just keep watching, I keep holding it. And I do quite know a lot of investors who have long-term positions, who hardly sell irrespective of what the price is, unless there is a material change in the fundamentals of that business. As you speak, are there fundamental changes in the businesses of Fidelity Bank?
I don't think so. If you even look at this judgment in itself, they've been aware of this for long. So somewhere they've been making provisions for in case the judgment doesn't go their way. It's not something that has happened out of the blues.
If they made provisions, means they catered for, so it will not even impact their P&L.
I'm just assuming that if they knew this case has been on for years now, at least since 2018.
Prudence.
Yeah, they could have said, "Oh, this judgment can go against us."
Under prudence concept, they should have done that.
Yeah. So if I'm an investor in Fidelity Bank, I would only see this as an opportunity to enter at a lower price. If I had Fidelity on my watch list, that's how I would treat this, to be honest.
Yeah, but we also need to look at is could it go lower?
Yes, I buy more.
So when I would see go lower, can it go lower?
I don't know.
Are they material developments that will happen soon that can make the price to spike?
Okay, let me take it off from there and pivot away from Fidelity Bank and talk about the market in general. Okay. We've seen first quarter earnings. Mm-hmm. The bank delivered fantastic results. Mm-hmm. We also saw improvements in industrial goods, communication, consumer goods, agriculture. Obviously, the impact of exchange rate has been kind of non-existent when you look at the Q1 results reported by most of these companies, like MTN, Dangote Cement, and the likes. In fact, some of them have seen foreign currency translation gains. So one would have expected that would have pushed the market to a level higher than what we are seeing today. Year to date, the NGX is 5.9% return year to date. So if you're looking ahead, do you see any catalyst in the near term, whether it's the next quarter, the next 3 to 6 months, that could spur the market to new highs from here?
If the momentum we saw in Q1 is sustained in Q2, which we will know by first week of July or thereabout, I see greater demands for Nigerian equities, especially the fast-moving consumer goods sector, because the Q1 results have shown that their worst days are over.
Mm-hmm.
And we see brighter days ahead. Exchange rate has stabilized. They have perfectly increased prices. The consumers has confidence with their new prices. Revenue is growing. Also, what was happening is that has even led to the revenue. It's not just the price that is driving the revenue. There's also an increase in volumes, driven that Nigerians are also now doing import substitution. people are now realizing that it is cheaper to utilize made in Nigeria goods than use the Nigerian the imported options. They take things like personal care items. You rather buy the Nigerian Unilever product than the UK Unilever products. So all that is helping boost the production, the revenue profile of fast-moving consumer goods. So I think there is future for them, and by Q2, if this result is sustained, there will be greater demand for their shares, and that would kind of also trigger a bandwagon effect on other share prices. It's not just the fast moving consumer goods, we also will see something similar in MTN. In Q2, the impact of the tariff increase will be more pronounced. Recall in Q1, that impact was just there for like 3 weeks. But in Q2, you have a whole 3 months. So we see the impact of that on their revenue profile. And that will be significant. If in Q1 they did what they did, and if they sustain it, and the impact of the revenue tariff increases applied, they will have a stellar result. So those are triggers that can lead to greater demand for Nigerian equities. What has also led to the law, the Nigerian equities, is that will have significant exits of foreign portfolio investors. According to the reports I've read, a lot of foreign portfolios have exited in the Nigerian market as a result of the fight for safety, which can be attributable to the tariff war triggered by Trump. So by Q2, that would have subsidized. We would have seen more of local stable players in the market. So, and we can begin to see gradual appreciation of the equity market. That is on the assumption that there are raw material changes in the interest rates that will drive away people's appetite away from equities
to fixed income,
securities.
or even worsen the flight to safety scenario we're seeing. Okay, great points you've raised there. And if I will add, we also, I don't know if we've seen the Q1 GDP report.
No.
We have not. It's not out yet. And I'm hoping that would be better than what we saw in Q4 2024, on the back of improved exchange rate. And of course, that is going to impact on all of these sectors that you've highlighted. And that should drop off on seeing a better GDP figure. GDP is the first thing that attracts foreign portfolio investors. If your GDP is trending in the right direction, you see more foreign capital come into that economy. So hopefully we'll see a better GDP figure for Q1 2025, and then see some of these guys come back. Looking ahead to next week, we have important earnings report coming out, particularly in the foreign market. Nvidia, Costco, Salesforce, those guys will be reporting next week. And speaking of catalysts, Nvidia is likely going to determine the direction of the market for next week. They report on Wednesday, and we'll be back next week to discuss those reports when they come out. Nvidia, Costco, Salesforce, and a couple of other companies. This is where we call it a day on this episode of Market Tape on Street Exchange. If you haven't subscribed, make sure to subscribe and click the notification bell so that you never get to miss any of our episodes. Thank you, Okudili, for being on this show with me.
Thanks for this interesting discourse. We'll keep open with the public, the viewing public, since value what we're doing.
Hopefully. Till next week.